Welcome to everyone who's just joined us. Welcome to our talk on disinflation, rate resets, and falling profits, navigating the business and economic outlook for 2023. My name is Jabron Larabir, and on behalf of the team at Kolleno, I would like to welcome you to our webinar today. So for today, really wanted to focus and hone in, on some key themes as we look into, further going into 2023. And some of the key kind of economic themes that will be impacting, business leaders, CFOs, and investors. I think over the last 12 months, it's clearly been a challenging year as business leaders have had to face, a number of different sizable economic events in 2022, including, for example, the rising inflation, supply chain constraints, geopolitical tensions, rising interest rates, labor shortages, quite a few sizable economic shifts on that end. And I think over the last several weeks, we've seen a number of headlines that are talking a little bit more about potential rate hikes, and recession talk has really ramped up across a number of jurisdictions. So, as a number of business leaders and CFOs look to plan ahead and look to think ahead about, some of the key economic activities or key economic themes that they should be paying attention to in 2023. We're happy to welcome our guest here, Richard Diaz. Founder and head of research at Acorn Macro Consulting, who'll be, walking us through some of his key themes and predictions for the coming year. So, Richard, pleasure to have you join us today.
Thank you for having me again. It's my pleasure to chat with you and try to figure out the world together, answer some questions, have a little bit of fun. I think people in my position often take themselves and their job a little bit too seriously. I think the most important thing to do is try to figure out what's going on and have a good time doing it. So thank you very much for having me.
Perfect. Thank you so much. And Richard, as we get kickstarted, as I mentioned, it's been a bit of a kind of unpredictable or challenging year for a number of our, business leaders and CFOs. And, it's always, you always have to take kind of economic outlooks for the year with a grain of salt, as you say, right? Especially as circumstances change, but as we start 2023, there's a number of business leaders and a number of the conversations that we're having here at Kolleno with CFOs. It's really centered around, some of the key questions that, our audience is looking at, specifically, as we go into the year, how can we navigate the economic uncertainty that we're seeing? How should we create scenarios and plan, for the next 12 months? And, how ultimately can businesses sustain their operations and maintain healthy cash flow to position themselves for success, both in the current economic climate and going forward, right? So I know in your analysis, Richard, as you look to 2023, there were really kind of 5 key themes that you pointed to. The first being, disinflation as we go into the year, the great rate reset, labor's last stand, decline of profit margins, and a turning tide on ESG as being, 5 key themes that some of our stakeholders should be looking at. So, Richard, I'll hand it over to you. Would love to kind of get your perspective on some of these key themes that you see over the next year and some of the considerations that you see for, our audience as we go forward.
Sure. Yeah. Thank you. And feel free to interrupt me, by the way, as we go through this. So I'm always reluctant to forecast, and to sort of, my job is sort of predict the future, but at the same time, I'm reluctant to forecast. And why do I make the distinction? Often because, as new information presents itself, like an invasion of a particular country in Eurasia, or of a pandemic or whatever it is, often you have to incorporate that new stimuli into your thinking. And so what I like to do, and maybe it's a play on words and maybe it's not, but what I like to do is sort of just think about themes that I think are endogenous and will sort of will survive any kind of any factor or sort of anything that's out of left field that might affect my outlook for the year. And that's why I sort of laid out these 5 themes as you stated, and I'm happy to sort of walk through each one of them with you now, and of course handle and take any questions along the way. And so I think let's get started. The first one is disinflation. Now, I think it's important to, before we figure out where we're going, sort of talk about where we've come from. And it's not long ago that every single policymaker under the sun was trying to convince the regular people, Joe Sixpack, that the inflation that was inevitable from the lockdowns, from the outrageous monetary policy intervention, and from the enormous deficit spending was so-called transitory. Now, I would remind everybody that even Mount Everest is transitory. You wait on a long enough timeline, even the largest mountain will, through evolution, gravity, and wind, well, well, not evolution, but it would eventually it will disintegrate over time, and through if you wait on a long enough timeline, any big mountain will eventually sort of disintegrate into tiny molehill. So it's important to and the reason I bring that up is because, we were told that this inflation, as a function of these three processes, lockdowns, deficit spending, and monetary policy, would dissipate quickly. And what we're being told, and what we're finally seeing after now almost 3.5 years into this, is that wasn't true. Now, some of us, we sort of were arguing for that at the beginning, and be that as it may, now we're here, and now we're sort of seeing that although we've had a lot of inflation, the next step in this journey is not for more inflation, it's something called disinflation. Now, some people might not be aware of what that means, but disinflation is just lower inflation, or that's to say that this blue line that you can see here, which is the OECD headline inflation number, is starting to, instead of rising, it's starting to fall a little bit. And now that's sort of inevitable for a couple of reasons. One, something called the base effects. In effect, it's very, very difficult for that number to continue to ratchet higher. But also we're seeing the reasons why which we got it in the first place are starting to sort of unwind, which is the monetary policy stimulus, which is, obviously lockdowns are receding. Finally, we're seeing that in China. And then we're seeing, obviously, the unlocking of some of the supply chain issues. The reason this is important for companies is because, a little bit of inflation is a good thing. A little bit of inflation can allow companies to sort of increase their margins. It means that there's excess demand for products. And then so the opposite is often true. And so, this is a model that I don't really usually try to focus on models. I think you can make a model tell you anything you want. And so you got to be careful when strategists present models, because you never know what kind of funny business is in the background. But what this is trying to show us is the producer prices for the globe, which is what and money supply really dictated what was going on in inflation. And we're starting to see that the most of the kind of apex of that impulse is sort of behind us, and that's and so I think that's very clear from the chart. I think it also will affect, but for businesses and people who and for consumers alike, it also is going to change their sort of psyche as to what might happen in the future with respect to price increases. Now, that is not to say that price increases will dissipate; they will not go away, but they will just rise at a much, much slower pace. And that's what sort of this blue line sort of following this red line means. So, year on year price increases, I'm expecting it to still be in the 5% range towards, the first quarter and second quarter of next year. And that is not at all transitory. Not by any stretch of what policymakers like Janet Yellen and Joe Biden and the ECB and Bank of Canada, whatever, were telling us, almost 3.5 years ago. So it is important that it is finally and slowly starting to alleviate some of the pressures that we're seeing, price pressures that we're seeing. Any questions on that before we go on?
Yeah, and just on the disinflation here, Richard, are there certain contributing factors? So you mentioned, for example, like the easing of supply chain issues. Are there other kind of key contributing factors that are really kind of pushing this forward? That's one. And two, are there specific sectors or areas or commodities where we'll start to see that and start to kind of see that trend really start to push forward as we go?
Yes, that's an excellent question. So I think that the one, so it depends on which country you are, of course. Each country will have a different sort of set of inputs, and the weight of each input might be different. But let's just say, for example, let's use Europe, North America, and Canada. Obviously, Canada's in North America, but just for the Canadian audience, there's a big factor of this sort of retrenchment in inflation is from energy. So we've seen energy prices, whether it's natural gas, whether it's crude oil, whether it's gasoline at the pump. We've seen a massive run up, and now we've seen sort of a natural sort of an ebbing of that, that impulse. And so in some cases, natural gas prices are back down to where they were at the beginning of 2021. They're still 5x what they are. A European natural gas price still 5x what they are in the U.S. But needless to say that they're much, much lower than they were in the summer. Pump prices in Canada are obviously lower, in the U.S., et cetera. And so that is depending on what CPI basket you're using, I know in Canada it's about 7%. In the U.S., it's slightly more. Of a consumer basket, you imagine it's roughly the same if you're a business, depending on what kind of business you are, of course. And so, you take that rate of change, you multiply it by the weight, and you sort of get what what the result of that is. It shows sort of the direction of travel and also how the influence that you have on sort of a headline number. What's important also to note, though, is that there's also core inflation. So core inflation usually removes food and prices. In other countries, they try to remove volatile items and try to account for the supply chain issues and as acute problems in a particular industry, like semiconductors or whatever. And so, and we're also seeing sort of a peaking in those sort of other types of inflation measures. And then the other thing that's really important is so that's one, and the energy piece. The other thing that's really important is the commodity piece X energy. So what are commodities? That means like goods, so apparel, home furnishing, white goods that you might have for your home. I said apparel, but there are different types of clothing. I mean, there's whatever you're buying at the pharmacy, and we can naturally, as supply chains open up, as the cost of shipping collapses, it's now back to normalized levels from a couple of years ago. As factories reopen in China and produce the goods that let's say maybe lacking over the last 6, 12, 18 months, we can see that the price pressures from those particular goods have come off significantly. And it's the same way those contributions are a factor of their weight in your basket times the rate of change, the result of that will be sort of how much it's pushing or pulling on your overall CPI or inflation number. One thing that's not, though, is services. So services are a much stickier portion of your CPI basket. So if you think of your total consumption basket, you have goods, bread, milk, eggs, cheese, oil, whatever, and then services, the dry cleaner, your babysitter, you're going to the movie, your baseball game, whatever it is. And so you have different types of components. And in general, your services tend to be stickier. What does that mean? Is that the volatility is much, much less than, or much, much lower, than the goods portion, which is, energy is a big portion of that goods component. So you can imagine the fluctuations of one versus the other is quite a bit different. The last part was just for where there's a difference between my view, where I think it's going to be higher inflation, but just less of it, e.g. disinflation, following this little red line. And then there's also a view in the market that we're going to get a sort of a collapse in inflation, and that blue line up here is going to head right towards zero and below it. I'm not of that view at all. And there's a couple of reasons. One, housing, there's a shelter component that's largely as a function of rents, and those rents are really, really high. And will stay there likely because there's, in some countries, and especially in the U.S., for example, there's just not enough housing in certain sectors. And then the other a point is that the wage growth. So there's, we're going to get to labor markets, I think, in a second, and then that's also helping sort of the stickier services component stay higher. Mm-hmm. So that's a good way. Hopefully, I rounded that out better. No,
that's perfect, and I think that ties in nicely to the second theme, which is around the great rate resets and what we're starting to see at the households and in the housing market as well.
Sure. So the second theme I have, again, some of these, just to be clear, some of these themes are interrelated. Some of them are sort of separate, but you can see that the world is, it's a multivariate model, right? So there's lots of different sort of problems that have different relating and sort of counterbalancing issues. So in order to deal with the non-transitory inflation that we've seen, central bankers in their infinite wisdom have felt the need to raise interest rates significantly, which, by the way, and if you want to follow the logic, sort of invalidates their previous assertion. So they're raising interest rates to fight inflation. Again, it's not clear that that's a good thing or bad thing. I'm not making a value judgment on that. That's just the reality of it. We've seen it everywhere. In Canada, they've raised interest rates significantly. In fact, I think that they raised interest rates just a second ago. They did by 25 basis points in Canada, which was as expected. And why that's important, because there's a lot of countries that are basically locked into the front end, or rather than the long end of the interest rate curve. So what does that mean? For each interest rates, you have different types of maturities. You have 1 year, 2 year, 5 year, 30 year, whatever. Those are usually related and or linked to government bonds, different types of corporate bonds. And the reason I think the rate reset is a big theme for this year is because there are certain countries that are highly susceptible to the changes in the short end of the curve. So you can see it from the chart that I'm showing you here. Each of the different colors corresponds to different duration or different length of maturity in the bond or in the liability that a particular household may or may not have. And I just want to highlight two very different realities, and then listeners can sort of draw their own conclusions, hopefully the right one, about what might happen in the future. So in the U.S., for example, we'll start in the U.S., which is this one on the right-hand side. It's a long-term fixed rate. So nearly, let's say 90%, just for the sake of brevity, 90% of all of their liabilities are linked to the long end of the curve. That is to say, their mortgages, which is the most important, the largest liability that nearly all households have, are a 30-year fixed mortgage. And that fixed mortgage, let's just say for argument's sake, was locked in at 3%. And so the major increase that we've seen in the short end of the curve, the 1 year, 2 year, 3 month, whatever, that we've seen in the US, which is about 400 whatever basis points, doesn't affect their mortgage payments. Does that make sense? So you have a situation where, whereas the opposite is true for Australia, where the variable rate, that is the rate that is directly tied to the central bank policy rate, is 90% of liabilities and mortgages in Australian households. So for every 25 basis point of increase that the Reserve Bank of Australia increases their short-term interest rate, it directly and immediately affects households in Australia. How does it affect households in Australia? It increases their mortgage rate or the amount of interest payment relative to the total mortgage payment, and reduces, all things being equal, it reduces their ability to spend on other types of products, right? It reduces their disposable income. Now, there are some mitigating factors that you must include, which is you can increase the duration of your mortgage. Instead of going from 20 years, you go to 30 years. Then often there's some kind of amnesty for some mortgage borrowers that can't withstand rate increases. But the point is, the real main takeaway is that there's certain countries that are highly, highly susceptible to this. So Canada is one that's really interesting, right? So the short-term and medium-term mortgages are an incredible amount, so 90% again. So that means so when you have the 1 and 2 year interest rates rise significantly, it very much affects the mortgage payments and the pressure on those households. What does that mean? The higher the interest rate, the more pressure on the household, and you get let's say a negative effect on the ability to consume other goods and services. Does that make sense?
Mm-hmm.
So the Great Reset. It's also true, by the way, for corporates. So just like some corporates borrow at the long end of the curve, borrowing, if they issue a bond for 30 years at a particular interest rate, there are some corporations that borrow at the short end of the curve, that borrow maybe a 1 year, or rolling 2 years, or whatever. And so you can see that this massive change in the central bank policy rate will have an effect that is disproportionate depending on where you borrow, and will also have a lagging effect. I think that's the other important thing. It will take some time for this phenomenon to sort of fully play its way through the economy. But it's just definitely a theme that I'm just paying attention to. I think is really, really important. And this chart here does a really, really great job of sort of illustrating the extremes that we're seeing and where each country might fit in.
Mm-hmm. Yeah, and I think from our perspective as well, what we're also hearing from clients as well is that's really top of mind for them, because I think from one perspective, from a household perspective, it's impacting consumer spend, especially in the real estate, construction industry,
Yep.
facilities management sector, And then from a corporate perspective, it's, how do we maintain, our cash flow and our working capital and kind of ease some of those kind of short-term, loans and things like that to be able to manage. Now, I know that you mentioned the Bank of Canada, for example, the recent announcement of the increase, 25 basis points. I think one perspective, or one key thing that analysts are also talking about is the Fed. So it looks like in February we'll have, of course, another announcement coming from the Feds on that. What do you anticipate coming out of that, and what are some of the kind of downstream impacts you see for that?
Yeah, I mean, I think it's more of the same of what I've described. So what's priced in right now, I think there's like a 95% probability based on some, options and so there's things called like swaps, there's Fed fund futures, there's different bond-like instruments that help you, quote unquote, predict what that future interest rate will be. If you look at the Chicago Board of Exchange website, you can see that. There's different, like I said, there's swaps, there's futures, there's options, and they all sort of help you triangulate what the market is expecting that interest rate will be in X amount of weeks, months, or years, or whatever it is. And right now, I think it's like a 95% probability that there's going to be a 25 basis point increase. I've written to my clients on my that it's going to be 50 basis points. Excuse me. Just trying to be a little bit different. I think that the main point is I think that interest rates are going to continue to rise. I think that's number one, the most important thing. And number two, I think where I also disagree with the market is I think that those interest rates will stay there higher for longer than what is anticipating. In the same way that the short term change is sort of bet on and triangulated between these and using these different types of markets. You have the same thing again for the curve. So they try to do the same for 2-3 years out. And there's a lot of interest rate cuts that are being priced in. I think they even start at the end of this year. And then towards the end of next year, there's like significant amount of interest rate cuts. I'm of the view that that's not really going to happen. I think, and that's as a function of again, related to my first theme, which is I think inflation's rolling over, but I think will stay quite high. And given the strength of the labor market, which is sort of our next theme, I think that's partly why my view is maybe a little bit differentiated from the market. But again, that's just me. I like to be a little bit different. But the reality is the market is basically certain that it's going to be 25 basis points on February 1st.
Perfect. Okay, great. And
so the next theme. Yeah. Oh, sorry. Go ahead.
Yeah, and just as we jump into our next Labor's Last Stand, I know we've got a number of attendees here. Please don't be shy as well. If there's any additional questions, please feel free to throw them into the chat, and we can discuss as we go.
Sure. So the third theme, is the strength of the labor market. Now, this chart doesn't fully explain that, and so, it's difficult to sort of incorporate 190 different countries and what they're doing into one chart and a couple of simple lines. So you'll forgive this kind of top line, 60,000 feet view kind of chart to sort of explain what I see as the sort of the most important labor market phenomenon. And what this chart shows is the age dependency ratio for the globe, the OECD, which is an organization of rich countries, and the US, which is the second largest country on a purchasing price parity basis, but a very large and obviously important economy in the world, probably the most important consumer in the world. And what this age dependency ratio means, and it says here, I'm gonna read it slowly and try not to screw it up. Basically, it's the ratio of working age people, the ratio of working age people to people who are not working, whether they're young or whether they're very old. I mean, not very old. I think it's over 64. My mom would be angry if she heard me say that. But older people, so over the age of over 64, under 15, relative to the quote unquote prime age working people. And intuitively, if you think about, that, just stepping back a second, it sort of makes sense, right? Like, how many people do you have? How many warm bodies can you put in seats to generate productive capacity in your economy in order to satisfy the needs of a sector of society doesn't work as much, does not generate as much productivity? Sorry if you're 10 years old or 80 years old, you're just not as productive as a member of society who might be 50 or 40 or 30 or what have you. And so what this chart shows you is where we've come from and maybe where we're going. And where we've come from is a situation where there's a lot of working age people relative to young and old. And that was in the 60s, and that's a function of the baby boom. Now, the baby boom is not true for all countries in the world, but it was very true for a lot of countries, a bunch of Asian countries, Japan, China, and then there was definitely true in the United States, and maybe a little bit less true to Europe. I don't think Germany had a baby boom, but they had their own shit going on, and so whatever. But the point is there was in the 1960s and 70s, there was a lot of working age people as a percentage of total. And throughout the last 50, 60 years, we saw that decline significantly. And we know this is true. Another way of showing this, knowing this to be true, is we know birth rates fell. We know people just live longer. Life expectancy has gone up from 65 or 62 in the 60s all the way to 84, 85 in some countries. And so we have less kids and more people live longer. And so that basically drove these lines down a lot. And now we're having a situation where after, almost 50 years of a clear trend line down, that is to say less and more and more working age people, we're finally at a really important inflection point. Now, again, I started this little section out by saying that I'm trying to use one chart to explain a significant, a large different types of phenomenon. So you'll have to forgive me. It's not as, maybe it's not as clear as obvious. But I think this change, this inflection point in demographics is, I think, one of the most important economic phenomenon happening in the labor market today. And what it means is it's just, you have a situation where you have just we have less, you're having fewer and fewer working age people as a percentage of total. And so if you think of supply demand curves, if you don't have enough supply, what happens to the price, as we know for the last few years with used cars and a bunch of other products, the price goes up. And so I think that as these numbers start to rise, as the age dependency ratio starts to rise, you have less and less warm bodies in order to fill these seats. And we're seeing this is true. And then there's other ways to sort of support this assertion, which is to say, if you look at vacancy rates, whether in the U.S. and Canada, you look at labor market surveys, whether the difficulty it is in finding people. And this is also a function of sort of skills mismatches. So for the last, 25 years, people have been doing sort of hobby degrees and not necessarily doing, spending too much time in university, and that, and doing sort of the wrong degrees, that it was a mismatch for what the market needed at this juncture. So for example, if you're a bricklayer, the median age of like a bricklayer or an electrician or whatever is, in the high 50s, and over the next 10 years, you're going to have a situation where these people there's just not enough skilled laborers that can match the demand. And so what that's doing is basically pushing up wages, just structurally higher wages. And that's where the reason I say it's a labor market last stand, because you have a situation where you have rolling over PMIs, you have weakening growth. I mean, we're going to get to why that's getting more complicated, but you have also a situation where even though that there's some clear negative impulses coming on, you have a situation where OECD wage growth is the highest been in 20 years. You still have vacancy rates in the UK, despite all the bullshit that we're dealing with over here, is still really, really high. You have labor market surveys that say that skilled and unskilled laborers are still difficult to find. So even though you have some, macroeconomic red, like flashing macroeconomic impulse that are flashing red, saying that the growth is slowing, we have the labor market that is actually doing pretty well, and you still have rising wage growth. And so that's where you have these opposing forces, and I think that this theme is one of these themes that is going to we're going to figure out towards the end of the year: is the labor market strong enough to withstand the slowing growth? And decline in profits, which is sort of the next theme, et cetera, et cetera. And the counter argument, though, people will say, well, the labor market's always lagging, and so it's this push and pull that we're about to sort of, we're about to witness. Now, for small companies, I think that the wage pressure, I think, is very, very clear. I just saw Walmart just raised its minimum wage to $14 US. I mean, we know this has been true for McDonald's and other types of employees that employ large amount of young people. Wage growth for young people has been the highest it's been, I think, in 30 years or so. We know this is happening across the board. And so it'll be interesting to see how that affects margins, which is sort of the next theme, and profits. It's also interesting to see how it affects sticky inflation and of course, ultimately, central bank interest rate policy.
And just on that, the central bank interest rate policies, just going back to what we were talking about before, we do have one question just around the interest rate policy itself, and what do you see as the kind of being the main driver for the reduction in those rates as we go forward?
I mean, it's an interesting question. I think we need to sort of just put that question into context a bit more. So, do we mean bond yields? Because we know that the 10-year bond yield is already down from 4.30 to 4.50 or whatever. Do we mean central bank policy rate? So maybe the person who submitted that question could maybe add a little bit more color to that. But I think what they meant maybe perhaps is central bank policy rates. I mean, I think ultimately central banks, they will calibrate the interest rate to economic growth and or inflation. Now, why I say economic growth and not just inflation? Because yes, the most countries and most developed markets try to calibrate their interest rate to keep their inflation between 2% plus or minus a little bit. They also take into consideration the future trend of that inflation, and that trend is obviously dependent on growth. So so that just to keep that in mind. So to answer the question simply, if we get a significant and severe downturn in economic growth, then there will be, I think, a corresponding reduction in interest rates.
In rates as we go forward. Perfect.
In rates, sorry.
And just on the labor point, I think it's interesting that you brought that up, because I think one of the key things that we're also seeing across the board, and something that we also had a webinar with Robert Hanna with specifically in the legal industry, was just around the talent piece. And I think part of what we're also seeing out there as well is there are a number of businesses that are responding by kind of streamlining some of their kind of labor, and then there's others that are taking the perspective of given the talent shortages, given the mismatches, holding on to talent and figuring out how to kind of navigate that. So I think it's definitely a very germane point for our audience as well around that.
Yeah, I mean, like the reality is, like, it's very difficult to have a recession and not have a corresponding decrease in employment. So that would be sort of the counter argument to say, well, it doesn't matter how strong the labor market is or how difficult it is to find people to work for you. If you have a significant downturn in economic activity, people are going to get laid off. And it's difficult. I won't outright deny that. I mean, you can see Google and tech and a bunch of Google and the other big tech companies, are laying off people as they try to cut costs as margins and sales start to fall, and they're trying to protect their earnings and whatever. But I would just refer us back to this chart, and I would say we have not seen this phenomenon in 60 or 70 years, a situation where you just do not have enough warm bodies. And I would refer to everybody to something, to what the vacancy rates, the job openings surveys. The Canadian Federation for Independent Businesses has its own survey. In France, you got the same thing. And basically across the world, it's just you were having just a very, very difficult time finding people to put in those roles. And it's not clear to me that after basically having a difficult time finding an employee, the right employee, training them, engaging them, getting them up to speed, that even in a downturn that might be mild, you would immediately get rid of them. And so that's where you have this sort of strength that I think that might surprise people going forward. Again, we'll see, of course.
Perfect. Thanks, Richard.
Yeah, no worries. So the next theme is decline and fall of profit margins. So this is a big call, and it's related to, again, like I said, it's related to the first theme, which is disinflation. It's related to the third theme, which is wage growth. But obviously this theme sort of is on it. Stands on its own. Now, one thing I'd like to point out is just where we were in terms of peak margin. So on the left-hand side of this chart, you have global equity market. So this is, thousands of companies, and you aggregate them. and what you get is profit margin. So your earnings, divided by your sales. And we could see where we were in terms of the peak profit margins. And you can sort of see the historical, peak to trough decline, as well as there's clearly an uptrend since 2008. And it's also and then you have on the right-hand side, you have sort of earnings, so EPS growth, so earnings per share growth year on year, and my model. Now, again, I don't take models too seriously, but it's just sort of an illustrative model to show sort of how earnings per share tracks this business cycle. And in this case, I use the South Korean economy, South Korean exports as the business cycle. South Korea is really plugged into the tech, obviously it's one of the largest oil refiners in the world, especially in Asia. They have a shipping business. They're rich, they're educated, they have a big service sector. I mean, and they produce cars, and they produce a whole bunch of stuff. And they're, the reason I use their economy and their exports as sort of a leading indicator on the global economy is because besides the fact that it works, it makes a lot of sense intuitively. And you can see here, now obviously, again, models are not perfect, I don't think, but it does show you that there is definitely we should not be surprised if that blue line, the earnings per share number, goes below zero over the next, 6 to 12 months. And the reason I think that that's very much likely is because I think it's very, very difficult in a world with higher interest rates, slowing sales growth. One of the charts I don't have in here, just because there's not enough room, is sales growth, which is slowing again. Higher wages, so think about input costs, higher commodity costs, higher energy costs, to keep your margin high in a world where if you have your margin that's rolling over and sales are rolling over, what is the output? The output is weaker earnings. And I think that's now. I think that's like an inevitability. You're going to have weaker earnings over the next sort of 6 to 12 months. I think the really, really difficult question for someone like me is the degree to which those earnings will be negative. Will it be a significant downturn where you get a year-on-year, where your earnings absolutely crushed, that fall 40%, even more in real terms if you think about that? Or will it be sort of a benign and mild sort of earnings recession like we saw in 2016, where you only have sort of a 5 or 6%, maybe 10% peak to trough decline in earnings? Then that's like, the $1 million question, obviously. For someone like me, you have to figure that out before you can figure out what's going to happen in risk assets. But I think what's important for small business owners or people who is to sort of have a realization that cash collection will be key, right? I mean, you're going to be able to, there's different ways to maintain your margin. I imagine, I don't know, Jibran, you'll probably know this better than I do, but as you have difficulty, if you cannot collect the sales or the revenue from your clients, then your margin will fall very, very quickly. And if you can improve your cash collection, then at least you can sort of slow the margin decline that you will otherwise feel from lower sales and higher input costs. So that's why I think this is a really important theme, not only for someone like me who spends more of our time looking at public markets and bonds and economies, but also for sort of on the micro level. I think it's just something to keep in mind.
And Richard, with regards to the decline margins profits, are there specific subsectors that you think are going to be kind of impacted more than others?
Absolutely. So I think that there are some sectors that having margins absolutely rip, right? So the energy sector margins are rising. I mean, basic materials, energy sectors and basic materials are seeing their margins at the minimum stay flat, and in some cases rise significantly. I'm not going to get into the whole energy thing, but there's just not enough supply to meet even a basic amount of demand, even in in an adverse scenario where economic activity falls. And so those companies are making money hand over fist, and they're doing so because their margins are rising. There's other sectors on the other side of the spectrum. You have tech, for example, whose margins are 28, 29% or even higher. And those margins, they've been over earning, for a long, long time. And you're starting to see with the falling sales, they're just going to have to take the margins are just going to have to fall. And then, of course, there's sectors in the middle, like consumer staples. It seems like their margins are unmoved by the machinations of the business cycle. They're always, 3 or 4 or 5%, depending on whatever it is. And so absolutely. It depends on which. I mean, here I've aggregated all the different sectors, but they're wildly different. And it's important, that's maybe a conversation sort of offline. I'm happy to answer that. But yeah, you have, on the positive side, you have the energy and basic materials, which are in a situation where, demand is not going anywhere for their goods, and there has not been enough supply. whereas the opposite might be true for tech. The tech's had extremely, extremely high margins for a very, very long time. And, that's sort of, gravity is sort of making itself known again. And so that's theme 4. And then, so is any more questions on theme 4?
No, I think we're good for now, and just keeping an eye out as well as questions come in on the
Sure.
Q&A.
Great. And then okay. And then actually, there's another question here. So what do you think, if you don't mind me, Jabbar, I'm just going to read it.
Yeah, of course.
Where do you think the governments are going to cut costs to combat the growing debt? So I think what's interesting to note, and that this might surprise people, is counterintuitive, is because inflation has been so high for the last 2 years, the debt to GDP numbers, which is the way that you sort of assess how much debt you have, you calculate your amount of debt, you calculate the productive capacity of your economy, your GDP, you do one divided by the other, and it sort of tells you in a way that you can compare across country how much debt you have. And debt to GDPs are actually in some cases lower than they were before the pandemic, which is incredible, right? And the reason and that's important because a little bit of inflation is a good thing. Now, don't ever tell this to a government official, because they will take that and, of course, run that into the ground. I'd never met an official on the left or on the right that likes a balanced budget. That just doesn't exist. But what's important to note is a little bit of inflation goes a really long way in helping destroy the value for the bondholders. And what does that mean? It means you basically allow yourself to inflate the debt away. And so that's why, despite the fact that the governments have been profligate and there's been such an incredible amount of stimulus, the inflation has actually lowered, in a sense, the debt to nominal GDP numbers. Now, there's no free lunch. We know that there's some downsides to this scenario. The downsides are for you and me, whose purchasing power has declined significantly in that time. The downsides are for the bond holders. We know that last year, for example, bonds lost something like 25% of their value, which is in some cases much more, which is incredible. So if you lent the government money in 2021, you've lost 25% of your assets, for example, right? So it was a transfer of wealth from the bond owners to the bond issuers, and that's what inflation does. And eventually there's different ways in which inflation is, again, a little bit of inflation is a really, really good thing, but then there's sometimes, if you don't get that under control, it can obviously spiral. Think Argentina or Nigeria, where you have inflation rates of 20 and 30 and 40%. And also bondholders, fool me once, you can't get fooled again. Eventually, bondholders will demand a much higher interest rate in order to compensate them for higher inflation expectations, which makes things more difficult for governments to fund future programs or capex or whatever. So there's no free lunch, but the last 2 years has been a sort of a sweet spot for those government debt to GDP numbers and household debt to GDP numbers in some cases, where they've actually fallen significantly. And if you look at the overall numbers, they're actually sort of where we were sort of 2 years ago. But don't tell anybody who works for the government that story, because they'll definitely take it and they'll take the wrong message from that little lesson.
We'll make sure.
So let's move on to the last one. The last theme is more, is more hope rather than dispassionate analysis. I think ESG is total bullshit, and I make absolutely no bones about it. ESG stands for environmental social governance. Now, on its own, it's important to keep those things in mind. What has happened over the last 5 or 10 years is that there's been a cottage industry that has come up in order to extract economic rent or outsized fees for crappy performance, and is also, I would argue, they've abdicated their fiduciary duty to return money to shareholders. And I think one way I can show you this is the vegan climate ETF. Hopefully they don't sue me, but this vegan ETF performs basically the exact function and so what I've done here performs exactly the same as the US equity technology index. So I basically just rebased the series to 100, and you can see that almost to the dollar, up and then down, and you can see there's moments where it's almost perfectly the exact same. That the ETF, the vegan, quote unquote, vegan climate ETF, tracks the technology index. Now, I'm not making a value judgment on vegans or climate or whatever. That's not the point of this. That's not the point of that. I'm more than happy for people to put their money where their mouth is. That's great. But what they should do is get what they pay for. And the vegan climate ETF basically just took the top 10 or 15 holdings of the tech ETF and matched it one for one almost. And then instead of charging a very, very small amount, which is what you would normally do for an index tracker, let's say 10, 15, 20 maybe 20 basis points, the vegan ETF charges 5-6 times that. And unsuspecting people who are not, let's say, as well versed as, let's say, maybe I am, they go and they say, hey, I'm a vegan. This is important to me. I'm going to pay for this. Or I care about the climate. Climate's really important. I'm going to pay for this. And the cottage industry that has grown around, in my view, misleading retail investors about what they're buying, the risks they're taking, and how much they're paying for it has exploded. And I think, and one of my hope for 2023 is that the pendulum will swing hard in the other direction, and people will learn that they've been, for lack of a better word, misled. I think you could use a much harder and more pointed language to describe what has happened here. But that is one of the ways that I think that this is sort of BS, and I think that we should move away from it. I think there's legal challenges that are being presented to this around the fiduciary duty of these funds and what they have to their clients. So, for example, for not owning particular sectors for some reason or another. The other thing is that I think that they've been obfuscating their political duty. So, for example, it's not clear that it's a net benefit for society that a small amount of individuals gets to push their view through voting, which is what owning a share in a company allows you to do, right? If you own one share of Apple, you're allowed to vote on strategy, the chairman of the board, compensation for Tim Cook or whatever it is. And by funneling all that money through to the ETFs, right or wrong, they've now control a huge amount of that voting power. And I think I think there's going to be significant pushback in this space. And I can only hope so, because I think what's happened, is really, really, I think, bad for the industry. I think it's bad for retail investors who don't know that they're getting fleeced. I think it's bad for certain sectors that need capital, e.g. energy, to make our life and the world that we live in more hospitable. And so, yeah, that's my fifth theme. Hopefully, Gibran, we won't get in trouble on that one, but I believe strongly in that, and time will tell. I think in the end I'll be right about this. So it'll be interesting to see how this happens over the next year, 2 years, or whatever.
Perfect. Well, as we wait for other questions to come through, Richard, one final kind of taking a step back and looking at the 5 kind of key themes that you've highlighted, as you're advising your clients going into, the next year, kind of high level, what are kind of 2 or 3 kind of key themes or ideas that you kind of emphasize that they should be looking out for as they're putting together plans in terms of spending, investment, stuff like that? Is there kind of like a few key bullets that you would kind of summarize it all for them?
Yeah, I mean, I think that 2023 is going to be a difficult year because you got pushing and pulling here, and so you have and I think it's I don't usually do this. I usually try to stay away from the geographic sort of the geographic segmentation, but I think maybe in this case it might be useful for people. So in the U.S., for example, you have a really strong consumer with a strong balance sheet and a manufacturing industry that's starting to retrench, and you have much higher interest rates. And you could argue that they are like ahead in the quote unquote cycle. You've got a cycle from expansion, contraction, whatever. And whereas, so that's like one end. geographically it's one end, and then in the middle you sort of have which is Europe. Forgive me for taking the normal boring global map here, but on the left-hand side, on the West Coast, you've got the U.S., which is ahead in terms of cycle, is ahead in terms of interest rate policy, has a strong consumer, has had the wage growth, et cetera, et cetera. And in the middle, you've got Europe, which has okay wage growth. Its interest rates are starting to climb up slowly. It's rebounding from a summer of hell, really, in terms of industrial and economic output. You've got on the East Coast, in China or Asia, you've got the other big economy, which is China, which is just waking up from its COVID zero policy, thank God. And you have a situation where the expectations in terms of equity markets and bond markets have all sort of lifted, but its economic surveys are still low, consumer confidence is still low, unemployment is still high, and they're only just starting to accelerate their economy. And I think that what we're going to have to deal with, I think, is sort of three separate but very important spheres of economic influence, all sort of moving at different paces and different speeds. And that's why I think it makes 2023 very, very difficult. And I think it's also, individually, you'll have to think about sort of where you're angled or aimed toward, and which part of that economic cycle, what your aim and what your target is, where it's going, and sort of what are those different problems. So in the U.S., you can see in the manufacturing sector, it's starting to contract after 30 months of expansion. Whereas, output for the motor vehicle industry in Germany is starting to expand month on month and over 6 months or whatever. And then, sentiment's rising. And then in China is still contracting. So it's really about sort of where your company is positioned, which sector, your sort of clients are. I think those are the key different considerations. Now, if your clients are in, the oil and gas or materials, maybe, it's a much nicer sky. There's no clouds, it's clear where the direction of travel is in. Whereas, if you're in the goods sector, you might have different trouble and you might have much more, much more cloudy skies ahead, if that makes sense.
Well, certainly, I think the key theme is just how murky the next year is just going to be, and there's quite a few different pieces that are going to be happening. I know that everyone will be looking for what happens in the Feds in February and kind of seeing where we go from there. So quite a lot to think about. I think this has been very helpful. For our audience, and I know for a number of our clients, these are kind of some of the key questions that we're hearing, and so I think this really helps, as people try to look around the corner and do their scenario planning and analysis, help frame up some of the key themes that our clients want to look at. So I do think I do see one other question. So it's coming in from Michael, who's saying, when discussing inflation, why do we not look at it from the pre-COVID to today? So when you think about it from pre-COVID to now, our money's lost a 20 to 25% purchasing power over the past 2 years. So what are your thoughts on that in terms of like the?
So I think he's 100% right. I think our money this is why when we talk about inflation being transitory, why people like me, I'm sure there was other people, but we're screaming. We're screaming yelling at clouds and saying how it was ridiculous. The policy stance was absolutely ridiculous. It was ridiculous then to spend as much money as we did, whether it was on monetary policy, interest rate policy, or deficits, because of this exact thing. There are people who've lost 20, 25%. You could say even more. I mean, in the UK, you've had 2 or 3 years of 10% inflation. I mean, that's almost 30%. So. I think he's 100% right. Why don't we look at it from pre-COVID to now, purchasing power? I think where that misses the trick a little bit is that there's been a lot of nominal wage growth as well, right? So, it's not enough to say that prices have gone up. The truth is that wages have also gone up. Now, that's not true for all countries. I know Canada has had terrible nominal wage growth, but that's a function of having the largest population growth numbers in 55 years. In the US, where population growth is very, very low, you've had nominal wage growth of 6, 7, 8%. So that offsets some of that really, really high inflation. I think but back to the question, when discussing inflation, why do we not look at it from pre-COVID today? I mean, I absolutely do. I think that, in this setting, I only got one chart to talk about it. And so forgive me, Michael, for not elaborating and sort of attacking your question head on. But I think you're 100% right. I think that's exactly the way you need to look at it, and why I think it was just such an outrageous lie to suggest that it was transitory. It wasn't transitory. Or another way of saying it, everything is transitory. The oceans were transitory. Mount Everest is transitory. So it's really, really. I think it was kind of a nasty lie, is a bit wrong word, but it was really, really kind of not a good way to position that economic phenomenon. I think a lot of people are really hurting. Whether businesses that will never revive, whether people lost money in their bond funds, whether it's people's purchasing power. I mean, yeah, we're going to be paying for the pandemic for a long, long time. And purchasing power is just one of those ways.
Perfect. Well, with that,
that's all the questions.
Yeah. Thank you so much, Richard. Really do appreciate your perspective. This has certainly been helpful. To members of our audience, thank you so much for joining us today. As I know we're reaching our time, please feel free to reach out if there's any other additional questions. Please feel free to reach out. And we're happy to reconnect and go from there. But Richard, as always, pleasure to have you. Thank you so much for sharing this. Certainly helpful, and look forward to our continued kind of engagement as we go forward.
Cool. Cheers. Thank you very much. It's been a pleasure.
Thanks, everyone.
Take it easy. Yeah, bye-bye.